Hey there, everyone. Happy Tuesday, April 14th, 2026. Welcome to Chart This with Dave Keller, coming to you from a gorgeously stereotypical spring day here in Redmond, Washington. Kind of cool, kind of wet, but we're all happy to be here. Thanks for joining me. Those of you doing so on the live stream, if you're watching the replay on our YouTube channel, welcome as well. Thanks so much for tuning in, and I hope that this brief time together helps you understand the charts a little better, appreciate the market conditions a little better, and improve your market awareness, which is our goal as always. We're live streaming on Facebook, LinkedIn, YouTube, and X. So if you're live streaming on any of those platforms, you can, if you're tuning in on any of those platforms, you can use the comment section there, and I can see your comments. I can definitely see your questions. I see a number of questions already or comments about the S&P 7,000 level. We just didn't quite get there, but my wife came upstairs because mid-afternoon Pacific time, which is kind of, afternoon Eastern time, I actually had my horn out and I was noodling a little bit, just kind of playing a bit. She's like, "What are you doing?" And I explained this whole thing. I'm like, "Yeah, we close above 7,000. I have to play on the air." She was cracking up. She's like, "Yeah, you better keep practicing." So, yeah, I need a brief pullback so I can get the lips back in shape, but I'll do my best to blast out some sort of notes if and when we close above that level. Nice risk on day for stocks, though, continuing the optimism that we saw yesterday. The market shrugging off any sort of negative implications and focusing on offense. We're seeing offense over defense. We're seeing advanced decline lines just start to break out. The small cap AD line actually made a new all-time high today. We're seeing major averages getting very, very close to making new highs as volatility continues to decline. And we're going into earnings season where there could be plenty of catalysts for further upside. Wells Fargo put out a note earlier calling this the market going on a sugar high, which if you have had kids or if you have kids of school age and you know what that means, it's great at the moment, but you know that there's this thing that's going to happen later, that crash, when you have to deal with all the behavioral issues. That's what worries me about this market here, that we're on a sugar high and not just eating well and gaining energy. With that in mind, however, let's look at the market conditions here through the lenses of technical and behavioral analysis. We will talk about the major averages and some of the other asset classes through indexes and ETFs, talk about what happened today. And again, kind of a risk on day across the board, growth over value, offense over defense, all at play today. We'll look at the market carpet. You're going to see some bright green in a lot of the leading growth names. And then I've hand selected a bunch of charts to go through, probably too many charts, to be honest with you. So I'm going to try to get to that point as quickly as possible because I've learned I'm not budgeting enough time to get through the charts. And that's where a lot of the magic can happen in terms of improving your understanding about technical analysis and reading the charts. With that in mind, let's check in on what happened today. The S&P making a new swing high here yet again. 69.67 and change is the official close. Really look like we're maybe going to hit 7,000 today. We'll see what happens if this optimism continues. That's as early as tomorrow, easy that could happen. The Nasdaq and composite a little bit better, about 2% higher for the Nasdaq and the Nasdaq 100, both having pretty good updates. As I mentioned, growth over value. So we're seeing yet again the Nasdaq related things and technology related things doing much better. Now in technology, you have that 1-2 punch of semiconductors and software both doing well. Microsoft and other software names gapping higher again today, continuing to inject some optimism here. Earnings happening over the next couple of weeks for a lot of those names. So we'll see what happens when the companies start talking. But for now, a lot of optimism going into earnings. With the major averages going higher, volatility is continuing to come in a little bit. The VIX opened just above 18. It kind of remained in the low 18s through the course of the day. So with the VIX below 20, we have a low volatility environment. We have the volatility implying smaller percentage swings generally in the major averages, sort of less anxiety, less uncertainty, and more stability to this uptrend. And that honestly, I mean, in terms of volatility conditions, I would say hard to imagine the S&P rocketing above 7,000 on higher volatility. Most likely need to see the VIX below 20 and see a grind higher. And that's what we're really just starting to observe this week in a way we haven't seen really since the end of last year, I would argue. All right, looking at some other asset classes. I had a really fun podcast interview earlier today. It's not ready for you. We'll get it out for you probably tomorrow or Thursday morning. Thomas Urano from Sage Advisory. He's actually a fixed income CIO, and I was able to ask him a ton of questions about the bond markets. It was a lot of fun to talk about inflation, not just macro stuff like inflation and the conflict in the Middle East, but how it's impacting the bond markets, why the bonds and stocks are so highly correlated, how to think about your fixed income exposure, how inflation, how change in the Fed governor, how that could impact, sort of the macro conditions, credit spreads. We touched on so many different things. So I'm excited for you guys to hear that. Until that's out for you, though, just a quick read on what happened in the fixed income markets today. Rates generally moving higher. Bonds and stocks have been fairly positively correlated. They're generally moving in the same direction here. And that's been the case for, most of 2026 here now that I think about it, but especially in the last 6 weeks from the end of February when the hostilities in the Middle East really kind of fired up. We saw bonds and stocks both going down. And now that we've seen this recovery after the ceasefire last week, we're seeing bonds and stocks also go higher together. And so rates are moving lower as bond prices are going higher. So the 10-year yield's down right around 4.25 after being up around 4.3% yesterday. The long bond yield is just below 4.9%. And the 5-year point below 3.9%. So rates generally drifting lower, where we continue to get optimism in equities and optimism in bonds, or at least additional demand. It's going to make mortgages less expensive, which is not a bad thing if you're looking to buy a house or refinance or something like that. So that's good. But overall, that's the trend that we're observing. TLT, which is a bond price ETF, up about 0.5%. The dollar index continuing to weaken, and so we're seeing that rotation as well. So the dollar and crude oil have been fairly highly correlated when conflict in the Middle East seen as a huge issue, both of them going higher. Now that we're seeing kind of it's not that bad kind of vibe from the markets, we're seeing a weaker dollar, we're seeing weaker crude oil prices. So dollar index coming in again. Here's commodities. We can see crude oil down again today. The USO, which is a crude oil ETF, down about 3.6% today. Other energy-related commodity ETFs all in the red. You're going to note that the precious metals, again, remaining fairly in line with stocks. So when stocks are going higher, gold's been going higher. Now, stocks may be a little bit better in terms of the technical structure at the particular moment, but decent update today for gold with the GLD up 2.2%, so outperforming the S&P. Silver over double that, up 5.5% over the same day. Looking at the cryptocurrency space, a lot to like here. Teasing our 75K level. We actually briefly traded above it a couple times through the course of the trade today. It's actually coming off a bit. Did reach as high as 76,000 over the last 12 hours, but coming down currently, sitting just around 74,200. So these are all showing in the red here, and that's just because they're down slightly here over the last 24 hours, but huge rally, of course, yesterday during the equity trading session when everything started to go higher. So cryptocurrency generally having a pretty good week. Bitcoin testing that key resistance. I did grab the chart of Bitcoin to kind of update on where we're at relative to resistance. Also applying some Fibonacci retracements, which I thought kind of helped frame out the rally that we've seen and what we may be looking for next. Boy, when was the last time we brought up the sector list and it was the FANG sectors at the top? I'd have to go back to the tape on that, but it's been a minute since we've seen this particular configuration. But here we are. The XLY, your top performing sector, up 2.2%. Technology, number 2, up 1.6%. And there's communication services, up 1.5%. Chart of Alphabet looking pretty good again. Chart of Meta starting to recover a bit. So communication services starting to enjoy the uptrend that we've seen from Amazon and some other consumer names, certainly from technology, especially semiconductors, which have been absolutely on fuego. In April, we're seeing communication services, again, driven by the internet-related names like Alphabet and Meta, doing quite well today. On the downside, only 3 of the S&P sectors were down, which again means that 8 out of the 11 were positive. So pretty bullish day in terms of the sector performance. But here on the downside, we've got consumer staples, which were basically flat for the day. Materials down about 1/3%. And that's sort of the stuff other than like mining stocks, which did okay. And then the energy sector, of course, tied to crude oil prices. So as crude oil prices coming down, the XLE coming down as well. It's so interesting when you look at the XLE, right? When you see a day like today and this week so far, energy have been coming down certainly since mid last week when that ceasefire was announced. Even though we have this sort of, I don't know if it's a blockade or not. It's sort of fluid, I guess. I'll do blockade in air quotes, whatever it is that is happening with the Strait of Hormuz at the moment. Crude oil prices still fairly elevated. Energy stocks coming down. You have to remember they're still up a ton year to date because they gained a great deal as energy prices went higher. I think, as things, if things are truly winding down, if we don't see any further escalation, if we do see a ceasefire that holds, and if we do see sort of a whatever the new normal is going to look like, and I think that's the real question mark, I can't imagine that crude oil prices go right back down to like the $60 mark. Like that just seems insane to me, because while the conflict appears to be starting to resolve itself or be resolved, I guess, things are different, and the stuff that's happened, I can't imagine how that would generally mean lower crude oil prices than before. And that's what we have to remember, right? When you have like the conflict that causes prices to spike and then the conflict's over and prices come down, we don't just go back to where we were and just pretend that like life is as it was. Like things have happened now, right? It's like we've broken up, and so it's like now there's the new thing. And I'm just not sure what that looks like, but I'm pretty sure crude oil prices are going to be above $60 a barrel. And I've asked people where they could see it, and I'm hearing, 80s, 70s kind of levels as downside targets, potentially, depending on how things all play out. That still means energy companies are going to be in better shape than they were before the whole conflict. So, energy could end up still being a pretty decent long-term play. If anything, we've learned that energy still matters quite a bit, and crude oil certainly matters quite a bit. So again, a friendly reminder, right? With energy stocks down again, the charts aren't horrible yet, most of them. But again, crude oil prices are what's most important there. We'll have to continue to wait and see. All right, breadth conditions, another kind of decent day for breadth. 64% of the S&P 500 members, 64% of the NYSE listings were up today. So at about a 2-to-1 ratio, slightly lower for the S&P, 50% higher, 42% down. But those are all fairly constructive, not lights out great, but still pretty good. So we're seeing better breadth conditions, as I'll show you in a minute. Advanced decline data continuing to trend higher, and so forth. Our market trend model, we have to wait until Friday's close. We update that formally every Fridays at the close. But if today was Friday and if this was the end of the week, our market trend model would be back to bullish on all time frames. That has not been the case for a while, right? It turned negative end of February, beginning of March, as we're going rotating lower. Short-term and medium-term models at one point were bearish. The short-term model turned bullish on the bounce off of the April low, and now we're seeing our medium-term model potentially turning bullish as well. A sell-off through the course of this week could change that, but we're at the point where my main risk gauge may be pointing back to risk on here, which is certainly something I'm going to be paying attention to. All right, looking at the mega cap growth names here, what we call the Magnificent Seven and Friends. Let's note that Meta is the top performer today, up 4.4%. We haven't talked a lot about the chart of Meta because, frankly, it hasn't been nearly as good as some of the other names out there. But having a fantastic upside this week, along with Alphabet, which is the other big weight in the communication services sector. Both of those stocks up pretty good today. Alphabet up 3.6%. Then we have a consumer name, Amazon, up 3.8%. Tesla, the other consumer discretionary heavyweight, up 3.33%. Big technology doing quite well here. We have NVIDIA, Broadcom, not up as much. Certainly NVIDIA sort of catching up and up 3.8%. NVIDIA is actually testing the upper end of that range and just kind of very, very close to breaking out. Actually might have broken above a swing high. I did grab that chart to look into a little bit later. Netflix up another 3%, which is pretty good. Continuing to hold that, gain that foothold above 100, which I think is a pretty bullish rotation. Boy, Apple just still not a part of the party here. And if you look at the chart of Apple, I think it's noticeably different than a lot of the other Magnificent Seven names. Right, a lot of these names like Amazon have had these big gaps higher and rotation higher. Just look at the chart of Amazon. Look at the chart of Apple. One of those big time participating in this upswing. The other one big time not even close participating. So Apple started to really, or continuing, I would guess, to really lag behind other areas. All right, I think that's it for the market recap here on the dashboard. As a reminder, I do see some questions coming in and a number of comments as well. Please keep your questions coming. If you're watching the live stream, we'll try to grab one or two at the end of the episode. Anything we don't get to, we will put in the mailbag and maybe include it in Friday's all mailbag episode. So what's happening on the heat map today? So I was looking at the heat map a little earlier, kind of preparing for the show. Couple observations that stand out to me. And again, I would encourage you to look at a visualization like this and really think about a couple different things. Right, the questions I ask when I look at this page. Number one, sort of high level read. Right, what's the overall picture look like? Does it feel like a bullish day or a bearish day? And then two more questions. The second one, think about sector themes and which sectors were working and which ones were not. And then individual stocks and groups, where we're seeing some individual stories we want to pay attention to. So going through each of those one by one. Number one, what stands out to you as you're looking at this visualization? I don't know about you, but for me, at a high level, it's sort of like if you take the mega cap growth names out and just kind of cover up with your hand, Alphabet, Meta, Netflix, Nvidia, Microsoft, Micron, Amazon, Tesla in the middle. Not a great day otherwise, right? Kind of an okay day. So this is one of those days that felt like it was the strength in mega cap growth as the story. The rest of the markets not necessarily really doing particularly well. Although the breadth was better than average, as we saw on the previous slide. Plenty of things actually flat to down today, right? So we're seeing some amber and some bearish red through the course of the day today. So I would say the fact that the mega cap growth names were such a big part of the story. And again, it's back to what we talked about, right? In like, it feels like mid 2025, where it's like the Magnificent Seven and then everything else. And we're debating how strong the markets can look if it's just the Mag 7 names doing so well. Well, here's your answer, right? The answer, if you remember, is market can do just fine, right? And even if breadth is good but not great, and certainly not very strong, the market can still go higher if a number of these huge mega cap growth names do pretty well. So we are in a position here where the sort of mega cap dominance is once again flexing its muscles. That's observation number one. Going quickly through the other comments on here in terms of the sector themes, obviously energy stands out as a downside participant today. Energy generally has not been a great place to be here in the last week. Once the ceasefire was announced, once crude oil prices kind of stalled out and started to come down, we're starting to see a lot of the energy stocks kind of give back a lot of those gains. Most of these stocks are still up quite a bit from the end of last year, but certainly not going the right direction right now. What happens is when you have a big uptrend and you have a pullback, at some point a pullback looks like something more significant, and you're certainly seeing the charts of the energy in the energy sector reflecting, sort of a sense that crude oil prices have peaked. And again, this is all based on optimism that events in the Middle East are going to continue to seem pretty positive. Someone had mentioned, nothing. I love this comment. Nothing makes sense. Hormuz is still closed, and yet stocks act otherwise. 100% agree. And this is one of those times, right? This is one of those times where I think you can get into trouble if you read the headlines and then just speculate on what's going to happen. And this is why I would say traders and investors that don't use charts are at a huge disadvantage, right? If I told you, look, there's going to be a ceasefire announced, but the Strait of Hormuz is going to be more congested than ever. It's going to be unclear whether ships are actually getting through there. And it's definitely not nearly as much traffic in terms of crude oil as was seen before. And if there is crude oil floating around, it's because Iran and others sort of already have ships outside of the strait that are still able to supply China and elsewhere with oil, but that's a limited supply, right? At some point that starts to run out. If I told you all that, you'd probably say, well, I would imagine the markets aren't really that optimistic yet, because it seems like there's a lot of things that probably should be weighing on this. And the ceasefire doesn't seem to be that be going that well in terms of some sort of long-term agreement. And the Strait of Hormuz is for all intents and purposes kind of open but kind of closed. But with all of that said, energy prices are going down. So investors kind of looking past those headlines, I would say, and just optimistic that this is over and we're going to get right back to the and things are great and the economy is growing and AI is an awesome place to be. That's what the market is telling me today when I'm looking at the charts. And again, the market does not care what you think should happen to energy stocks or crude oil prices. That is one thing I learned a long time ago. The market does not care for your opinion. So making sure we understand the evidence the market is giving back to us, and it's given me optimism right now. My skepticism, and I always have a contrarian hat, a skepticism hat that is usually on my head when I'm looking at the markets. When the markets are going higher, I'm always thinking about what will cause it to not go higher anymore. And I would say that is the biggest issue, right? Where I feel like we're one negative headline away from all of this reversing very, very quickly. It's just we're not seeing that negative headline just yet here. So that was a long-winded way of saying energy stocks are down here. Whether or not we expected that, it's certainly happening this week as crude oil prices come down. Significant upturn or continued strength, I would say, in the semiconductor space. Micron from March to April, completely different chart, just made a new all-time high yet again today. And we're seeing that in a number of different areas of the certainly with semiconductors, but not all of them, right? So this is a little bit of a different day than what we saw like yesterday. It was sort of everything kind of going higher. Today in the technology sector, a lot more mixed, right? We can see some names up, some names down across the board. Financials, I would say, continue to be an important area to watch. We've got a lot of earnings in the financial sector this week. JP Morgan, Berkshire, which are the two largest names in the S&P, down slightly today. Goldman Sachs up about 2%. Citigroup up 2.6%. That one made another all-time high here again this week. But having said that, still kind of a modeled appearance in the financial sector. This is the beginning of earnings season with a lot of financials, and then things like Johnson & Johnson and other random names peppered in over the next 3 weeks. It's going to be a lot of earnings to digest. Actually did confirm Nick Rach of the Earnings Scout is going to be joining me on the podcast later this week. That's on Thursday, so we should get that out to you probably over the weekend, maybe Monday morning. Nick is awesome. He is one of my favorite earnings experts. Used to run a sort of sell side research operation focused on earnings analysis, and he's got a really good methodology for thinking about earnings expectation and guidance. And I'm interested to get his take on how we should think about earnings this season. But reading some of his recent work, pretty encouraging, right? I mean, earnings are telling you things are pretty good right about now. What else on the heat map? That's probably about it. I would say generally, I mean, if you look, I mean, besides energy being mostly down and then the mega cap growth names being mostly up, other than that, it's kind of hit or miss. This was actually a very mixed day for equities. All right. Speaking of earnings, before we get to a bunch of charts that I've hand selected for you, I want to give a shout out to our friends at EPS Momentum. Appreciate them supporting the channel and supporting today's episode. If you like finding stocks that have real earnings growth and momentum behind them, this is the tool you need to check out. It helps you surface companies with accelerating earnings and strong institutional buying. We look at earnings through an earnings factor that's based on earnings estimate revisions, which according to their work is one of the most powerful drivers of long-term stock performance. On the institutional buying side, we look at price momentum factors like ATR, average to range, volume, and other things. So it's looking for stocks where both the fundamentals and the market action are lining up. And I love that it includes relative strength, which is one of the most important ways I like to follow price momentum. If you want to check out their new platform called EPS Momentum, you can use my link at marketmisbehavior.com/EPS. My link will give you 30% off a new account. So I'd encourage you to check it out. Again, marketmisbehavior.com/EPS. You'll get 30% off. Helps me make market misbehavior awesome. And I appreciate you taking a look. All right, let's look at some charts that I've hand selected. We got very, very close to 7,000, as my wife will confirm. And as I mentioned earlier, enough for me to get the horn out and start noodling around a little bit just to kind of remember how that feels. I don't play a ton anymore, to be honest with you. I do more, I'm a musician, but I do more singing than playing here recently. But I do remember a thing or two about how to play. So we're working some things back up here. Just in case we get that close above 7,000 tomorrow. It would not take much to do so after the rally that we've seen so far this week. I think the momentum shift that we've seen in the S&P 500 is one of the most impressive factors of this rally here. The RSI pushing above 60 on this rally sort of confirms that we're seeing real accumulation during this period in terms of how the RSI defines that sort of thing. You know, what's next? Well, we're out of resistance, right? I mean, the resistance, all right, the level is 7,000. I think once we get above there, we're in uncharted territory, pun intended. We put on our trend following hats. We assume that the uptrend is going to continue, and we continue to track that higher. We look to make sure that we make higher lows. When we have a market in a primary uptrend, which we're very, very close, I think, to certainly confirming, what that would mean is that we think of the market as innocent until proven guilty. What I was taught, one of my mentors, Ralph Akampora, when you talk about trends, he would say in an uptrend, don't worry about new highs. New highs are going to come naturally. Focus on the lows. Make sure when we pull back, we keep making progress, because the pullbacks to the low, excuse me, and making a higher low, that's what forms a long-term uptrend. That's what a period of accumulation looks like when you have dip buyers continue to come in and buy on the dips. So if we make break above 7,000, it's going to be about that next low. Given the rally that we've seen, by the way, I'm watching 6,800 as a short-term level of support. That was our line in the sand back here in January and February. I think the break of that line in early March was pretty important. If and when we do pull back, I would say holding 6,800 would be like an initial kind of basic level of support to look for. For now, though, stronger price, stronger momentum. It's a pretty good chart. Advanced decline data. I wanted to point out that the small cap AD line, which is the line you see in the bottom panel, breaking above its previous new all-time high in February. Sorry, folks. And so I would say the small cap AD line making a new all-time high is bullish. New highs are bullish. That is a basic premise of trend following and analysis. The rest of the AD lines, including the all-important NYSE advanced decline line, not quite making new all-time highs, but we're very, very close to doing so. If these AD lines are able to make new highs, whether or not the S&P itself is doing so, I would think of that as clearly a bullish trend. In terms of moving average breadth, happy to report that the long-term breadth remains quite positive. Not surprising, because we broke above that 50% level there, and we saw that earlier in April. So we have 58% of stocks above their 200-day moving average. The bottom panel, though, was an interesting one. That's the short-term breadth. What percent of S&P stocks are above their 50-day moving average? We can see that got up to 54% at today's close, and that's pretty encouraging. What's happened is the long-term breadth has turned back positive, but some of the short-term breadth readings, not quite getting back into the positive side of the ledger. It looks like as the week progressing, we're having more and more stocks above their 200-day, more and more stocks in the S&P above their 50-day. That's pretty bullish. So again, breadth indicators continuing to confirm this current uptrend. Volatility all looking very good as well. We see the VIX pushing further below 20. Yesterday, we closed below the 20 level, as we did on Friday session. We did break a little bit further down here. So now we're sort of in the upper teens. We finished today around 18 and change. VIX below 20, that's kind of where you want to be if you want this market to break above 7,000 and continue. Markets don't generally make aggressive new highs with the VIX above 20. It may have happened before, but not any time that I would say is worth betting on. VIX below 20 is the environment you want to see if you're looking for the major averages to push further. Now, I think where this is also helpful is this these charts that I've just shown you, right? The breadth in terms of the AD lines, the moving average breadth, how many stocks are above their 50 and 200-day moving averages. This one, the VIX, looking at volatility. All of these charts also, I think, will provide very clear signals if that bullish phase is no longer in play. And what you'll be looking for is the VIX spiking above 20, less than 50% of stocks above their moving averages, 80 lines not confirming new highs. If those things would happen, then it's a risk-off environment again. And I think given, a number of people in the comments are mentioning they don't believe this rally, they're skeptical, afraid to play the short side, but just really doubting. I hear you, and I know why you're thinking that way. I think the great thing about these sort of macro technical charts, these things like breadth and sentiment in the form of volatility, they can confirm an uptrend, but they are also very, very quick to signal that an uptrend is no longer in play. So VIX above 20, I think, is an important alert to be watching for. Has not happened yet. It'll happen at some point. I want us to be prepared when it does so. Here we're looking at currencies and commodities. I just want to point out the trends that have been in place since early April continuing here. And to start off the month, we saw crude oil prices and the dollar remaining fairly elevated. Since last week, with the initial announcement of a ceasefire with the U.S. and Iran and Israel, etc., we've seen the dollar continue to drift lower. We're seeing crude oil prices continue to drift lower. The crude oil contract that we're watching here finished today right around $92 a barrel. That's down from around 115, 117 really on an intraday basis, even as high as 120 earlier in March. So we're seeing crude oil prices come down as expected, given the fact that conditions are changing. We're seeing the dollar rotate lower, which means investors are going risk on. We're also seeing a resurgence in the uptrends in gold and silver. Gold is actually testing its previous high around 4,800, previous swing high, that is, from the end of March. Very, very close to breaking out. And I think gold continue to be in a constructive setup here. Sorry, I'm finding my voice has about 26 minutes of capacity, and I'm pushing it past then. I'm going to have to tighten this up. Bitcoin trade briefly above 75,000. I think that's important to watch. We topped out right at 76,000. That's actually where we topped out in March. The RSI is currently holding steady right around 60. It's not a bad thing. This is actually pretty encouraging. A break above 75,000 with the RSI pushing above 60 is what we've been looking for. Not quite seeing that, but we're kind of right at that threshold, which is why this chart, in my opinion, not quite ready, but sort of right. I mean, just teeing up and ready to go. We are testing resistance. The momentum is right there, a little bit further, and that looks like a pretty bullish breakout. This is a ratio that I've loved to show before. It's really one of those classic comparisons between sort of an economically sensitive area of the market, hotels, or maybe a consumer-focused area of the market, and defensive area of the market like utilities. When this ratio is going higher, that means hotels outperforming utilities. That means kind of risk on. When the ratio is going down, hotels underperforming utilities. The essence of this is something I picked up on years ago. A guest that I interviewed on Stock Charts TV talked about this ratio, and their comment was, look, I think hotels are just a great way to measure how much consumers are willing to spend on something they normally wouldn't. Utilities are things that are generally pretty stable. Now, that conversation I had with him was years ago, before utilities had their run as kind of a growthy sector. And you're seeing that like in July, August, September of last year, when that ratio was trending lower, and we're seeing the S&P 500 trending higher. And so that was because utilities were doing quite well, because utilities were kind of following that surge in technology and showing quite a bit of optimism. But after that point, kind of settled back in. And I think it's worth noting this ratio has been really helpful so far in 2026. Actually started the year doing pretty well, going higher. February, we saw rotation lower. And look how the rotation actually broke down well before the S&P itself actually broke down. Then We saw this ratio bottom out second week in March and start to turn higher while the S&P continued lower here. This might be an interesting ratio to watch to see if and when we start to get a downturn, because it's been leading the market here by a week or two. And so leading indicators are often things that I like to pay attention to. That ratio for now kind of showing risk on, but something we'll keep an eye on. All right, to finish off, let's look at some individual names, just highlighting the fact that NVIDIA is testing the upper end of the ledger here, really, really close to breaking out, arguably making a new 3-month closing high today. Semiconductors generally have been doing well. NVIDIA has been lagging behind a little bit, but starting to really participate here today. Microsoft continuing to do quite well. Another gap higher, closing right at, almost exactly at the 50-day moving average today. That's not true, just slightly above there today, to be honest with you. So Microsoft regaining the 50-day for the first time really since last fall. RSI very, very close to breaking above 60. What we don't want to see is this sort of environment where we rally up to a key moving average. The RSI never really gets above 60. That tells us to be skeptical. We're kind of right at that point where I need to see more. I need to see further accumulation and the momentum improving just a little bit better. Microsoft continuing to have a pretty solid week, though. Amazon gapped higher last week and has just continued to run higher. 4 straight days now of closing above the open, and a couple days closing right at the highs of the day. Pretty impressive run. New all-time highs, very, very close here as we're now just above, right around 250. RSI extremely overbought, which is actually often a pretty encouraging sign when you see that much bullish momentum. But for now, Amazon really driving the consumer discretionary sector higher. Earnings are so important. We've got JPM as one of the earnings names today, for now trending higher. Today down slightly, though, down about 0.8%. But generally, since that gap, it's stalled out a little bit. Yesterday, on Monday's session, we closed at the highs of the day. Today, we gave back a little bit about that. Finished about halfway between yesterday's open and close. They're reporting earnings today. I think, again, could be a really encouraging start to the earnings season if we see charts like JP Morgan continue to appreciate through their earnings release. Still to be determined whether or not that's going to happen. Holding that recent swing low in the upper end of that gap around 305, I think would be pretty important. We highlighted TMO on yesterday's show. I left it on the list here just to update that. It's up another 2.5% today. Today, as we talked about in yesterday's session, we need to regain the 200-day moving average. We need to break above 520. We need the RSI to go above 60. All three of those things did indeed happen. So I would say nice breakout on Thermo Fisher. If there is a downside reversal tomorrow, that could negate the breakout. But at this point, looks like a nice encouraging move back above the 200-day moving average. Final chart, then I'll take a minute and give a question or two. Airlines all having a pretty good day. UAL actually only ended up about 2.1% today. It's still about below the 200-day moving average. As long as, these charts, I would say generally these charts are still not great charts. There was the merger rumors between United and American, at least that was discussed. I think it's a long way. I think it's a long way before something like that would actually materialize. But it was enough to inject a lot of optimism on the charts like UAL. UAL actually did not react as well as you would have hoped. Love to see that get above the 200-day. It's also red at $100 a share, which is an important parity level. Charts like Alaska and some of the other names that are actually more near 3-month lows, having a nice rotation off of those lows. Southwest is another one. LUV that I'm looking at. All right, a question or two before we finish off. Hey, thank you for the congestion home remedies. If you knew the number of things I've been putting in my body, mostly healthy things to try to get through this, you would. Hopefully, you would be impressed. But I'm working on it, and I appreciate the kind words. We'll get there. Right angle triangle. Thanks for a number of your comments you made along the way. You said this one. I pick up some stocks when the VIX is above 30. Now winding down those positions when VIX is below 20. If I remember right, And I don't know if it was you or someone else, but when we talked about the VIX popping above 30, someone mentioned nibbling a little bit. And I think it might have been you. And if not, it was your doppelganger who was watching the show, but I'm pretty sure it was you. And if so, well done. I mean, you picked up on thinking of the VIX like a contrarian, which is when the VIX spikes above 30, you start to nibble because that's often, the VIX usually doesn't get a lot above 30. And if it does, it doesn't stay there that long because that means the market's in a pretty significant downturn and we're probably going to have an upside reversal at some point. So it sounds like if that's true, you played that reversal very, very well. It's tough to be buying stocks, as you probably considered, when the VIX is that high, because that means the markets are going down aggressively. So you bought a falling knife. When it works beautifully. When it does not work, it hurts so bad. But I appreciate you saying that. I think that's been a brilliant way of playing here the last 6 weeks or so. And congrats, and thanks for sharing your way of thinking about that. We'll certainly keep an eye out the next time the VIX pops above 30. Folks, thanks so much for joining me here on the live stream today. I'll continue to tee it up and we'll keep getting better and better. But thank you guys for tuning in. Thanks for the great comments and questions. If you're watching the replay on our YouTube channel, please take a moment and drop the questions into the comment section. We'll consider that as part of the all mailbag episode on Friday. In the meantime, have a great evening. And remember, it's always a good time to own good charts. Take care, folks.